Hey guys, Adam Rose, Vice President, Senior Loan Officer of Western Ohio Mortgage here in Sydney, Ohio. Today is another episode of the Mortgage Guy Podcast. Today we're going to talk about Fannie Mae's new risk assessment, removing some credit criteria that they have in the backside when we're running the findings through their system, and a couple non-QM things that I wanted to touch on, and all coming to you now. So let's talk about this Fannie Mae change. All right, so Fannie Mae, Freddie Mac, all right, doesn't matter. But it's conventional financing, right? We always connect conventional financing with high credit scores or down payments and things like that. That's what you think of. The bare minimum credit score that Fannie Mae will even accept is a 620. Now, I can tell you from experience, in most LOs, if you're watching this, you can agree. Most realtors, you can agree. If you're a 620, more than likely you're not getting an approval on conventional financing. There's something going on in that credit profile that is causing that 620 that conventional is just not going to like. Even at 640, big old question mark, right? You have to have a pretty sizable down payment to get that approval. Well, DU, which is Desktop Underwriter, that's their system that we run your information through to see if we get an automated approval or not. It started on the 15th, but they are removing the 620 minimum credit score out of the credit profile or the mix or the risk assessment. So that won't be a requirement to go through there. So that's a plus, right? That's a plus. But here's the thing also, right? Just like we said, having a 620 getting approved is unlikely. That's why we have the USDAs and the FHAs and the VAs, that it's just a better solution for you. And if you've watched our podcast in the past, we've also talked about how Fannie Mae, Freddie Mac have LLPAs, loan level pricing adjustments, right? So depending on your credit score and your down payment, they hit you, right? And it costs more money, or your rate's worse. Just imagine what it's going to look like now with a sub 620. I mean, it's going to be so far out of the ballpark compared to an FHA file. I personally just don't think it makes any sense, but it is what it is. I mean, it's like they're trying to get back to the old school ways of how it was in the 90s, right? There wasn't really credit scores. I mean, everything was manually underwritten. We looked at your credit profile. Did you have any late rent payments? Did you have, what do you got? We're validating all this information. So I do applaud that it's trying to go back that direction. And I think it'll help more people that are at that 640, 650, 660 range, keeping automated approvals for conventional financing, even if you don't have a sizable down payment. But sub 620, the removal of that, in my opinion, is totally worthless. Why bother? I think the cost is going to be astronomical. But what the hell do I know? So what they're doing to help offset it, they've included rent payment history. So, when you go to Experian Boost, which I've talked about that before, you can actually have your rent reported to the credit bureaus, and that way it shows up every month. You can use it that way. Again, the big key here on rental history is 12 months anyways. That's what they want to see. They want 12 months. But satisfactory payment arrangements on your rent, you can add it to the credit report through a credit supplement. So as long as we're documenting that, that's a big thing that they're trying to put this on to offset some of that risk. And then now they're also changing DU findings to, if you were a first-time home buyer, is no longer considered a negative risk factor. It's actually a positive risk factor, which will also help a lot of people get more automated approvals. But again, just because you get an automated approval doesn't mean you should necessarily go with that route, because if your credit score is bruised, your rate, the cost, the discount points, whatever it might be, is going to be not great, right? It's not going to look good compared to other programs, right? So we want to look out for what's best for the client. If it's conventional, that's what we're going to do. If it's FHA, that's what we're going to do. It's just, as buyers and realtors, everybody in the industry or in the market knows that a conventional offer always looks better. But they're not asking questions. How strong of a conventional buyer is it? Which might be a question they start asking now with these changes. But a lot of agents, they want to just remove the concern of whether a property is going to meet or exceed expectations for government lending, right? I mean, we have one right now, fails water tests. We see that all the time. And that sucks, and we got to fix it. But at the same time, going conventional and avoiding like a water test, for example, could put your borrower at risk. Not necessarily financially, it could be, but health-wise. I mean, that's the thing. So isn't it better that we catch some of these things up front and make sure our consumer is set? I mean that's my opinion, but yeah, again, what do I know? But the whole purpose of this is they feel that with this risk assessment, that lenders, and I'm going to get to it, is going to have a little bit more enhanced oversight in regards to what might happen or the potentials of buybacks. And a buyback is basically your loans not performing well, right? Whether it's the first 12 months, it could be 3 years from now, because we've seen those. You get a random email from the loan servicer. Fannie Mae wants this reviewed. They want to buy back. They want to sell it back to you, or make you buy it back, should I say, because maybe a single 30-day late payment, they don't like it. So when those things happen, they kind of dig into the appraisal, try to find something wrong with it to really just give an excuse to make you buy it back. So these are some of the risks that us lenders take constantly, every day, every file that we close, that consumers, agents don't see or realize, which is why some lenders have some crazy underwriting requirements, right? You're like, why the hell are they asking for that? Well, there's probably a reason. It may not be a good one in your eyes or common sense, but something happened, right? I mean, there's no other explanation. They had a buyback, something happened, an investor didn't like it, Fannie Mae didn't like it, whatever it might be. But that's why that is. All right, so let's get out of that, because you don't really care that much about it. But let's talk about non-QM. So, we've always done non-QM. We're not a big lender on it. And it's more of just, we don't have a lot of control over them, because we usually send these out. We do offer them, and we're trying to get better at them, understand them better, to make sure that we're filling the needs of some of our clientele. And what's crazy is last year it was like 25 or 30% of the market was non-QM. And that says a lot about what's going on out there in regards to people, more self-employed borrowers, or writing off all their income on their taxes. So we're having a hard time documenting that. Investors using, DSCR loans and bank statement programs and stuff like that. So we felt the need. We really should dive into this a little bit deeper, make sure we can provide everything we need. And I've talked about DSCR, I've talked about bank statement programs, but we have a whole plethora of other programs that are very similar that kind of fit the needs of bankruptcy rules and stuff like that. Two I wanted to touch on very quickly that I think could be a game changer, which I'm not saying other people don't offer them already, just saying we do now, is the 1099 program. I think this is a big one. So there's been a lot of times where we've had W-2 employee forever, and just this year, when they decided to buy the house, they went to being self-employed or a 1099 consumer or borrower. So 1099 means, hey, I'm still doing the same work maybe, and I've just kind of branched off on my own, and I'm being subcontracted out to do this work. They send me a 1099, I file all my taxes. But technically you're self-employed, right? Because you can write off expenses. Well, the cool thing about this program is, it's November, right? So even if you went 1099 in January, let's say, you don't even have a tax filing yet, they're going to average the last 2 years of your W-2s. Again, this is assuming you went 1099 in a similar field. Last 2 years W-2s and your year-to-date income on your self-employment, and average it and give you that income. That's crazy. That's not a common thing, because as I've taught you all before, to my loyal following of 7 people, is you typically need 2 years of tax filings for self-employed. So I think that's pretty cool. Could fit a need in there. I specifically said truck drivers. I mean, there's been so many times where drivers went from hourly to salary to per load. I've seen some per hour and per mile. I mean, there's a lot of different variances on how some of these people get paid. Some of them branch off on their own and do their own thing, but they're not driving their own truck. They're driving for the company truck. They're just 1099. I think that's a cool fit, and that could work. The other one I want to talk about is asset depletion. So this can be mixed with your regular wages. But let's say you're trying to buy a house that is outside your price point, but just absolutely love it. Can't get your debt ratio to work, so you don't have enough income. Well, and again, as I mentioned before, non-QM rates are a little different. Okay, they're going to be a little bit higher because there's a bigger risk involved. But this asset depletion is going to take an IRA, mutual fund account, your Roth, whatever you've got, side account, retirement accounts, a couple $100,000 in it. We document it, and we're going to divide that over 36 months for an asset depletion, and we're going to add that to your monthly income. So let's say you had $90,000, I don't know, $90,000, we'll say, and we're going to divide that over 3 years. We're going to give you $30,000 a year in income, additional income on top of your wages, right? So $2,500 a month. That extra $2,500 a month is going to totally change your debt ratio, totally change how much you could qualify for. Now, most of those programs come with a minimum 10% down. They're typically higher. It's tiered based off of what your credit profile looks like. Okay, so you do have to have a pretty strong down payment. It's a pretty strong credit profile, I just think it's a great program to talk about, and I think everybody should be aware. And it might fit the need for a couple of you out there. So that's all I got for you this week, guys. All right. When this is airing, I will be in St. Lucia. Ha, suckers. So I hope you all enjoy it. If you have a bunch of comments, holler at our office. Justin, that works for us here, will be able to take any questions in regards to any of these programs we just talked about. But remember, subscribe on YouTube. It's free. Check us out on Spotify, Apple Podcasts, and we'll see y'all when I get back.